Can you see my screen okay?
Yes, I can see your screen.
Okay.
All right, let's do a sound test. Can everyone hear us? Can you type something in the chat if you can hear us? This might just be a morning thing. Okay, got it. Perfect. All right, so I want to introduce Gavin from IDEO. We'll be doing a session on the design and risk of staking derivatives. And we're really excited to have him back again. He spoke on a panel yesterday, and I will let him take it from here.
All right. Thanks, Shinju. Good morning, everybody. Thanks for tuning in for this. I know it's early for some folks. So yeah, what we're going to spend a little bit of time on is derivative and risk design here. So quick little bit of background on me. I work at IDEO Collab Ventures. We work with a lot of teams in the space designing products, protocols, things like that. Previously, I was an engineer at BitGo. So I've worked on a lot of things from design of protocols and primitives all the way up through products that people touch. And so as we've been looking more at staking derivatives, a lot of things have become apparent. So anyways, today I'm going to talk to you guys a little bit about staking derivatives, which is kind of one of the trends that's been showing up right now. But I'm going to share a little bit about some of the risks that aren't immediately obvious when you start looking at them, and then some of the important things to consider if you're starting a company or a protocol in the space. Because, I mean, to be honest, it's like 5 years ago, how many of you guys thought were even thinking about derivatives or thinking that they were interesting? And suddenly, when they show up on the scene, everybody's talking about them. But the last time I heard about derivatives this much was like 2007 and 2008. So, you know, some flags are going up. So anyways, let's dive right in. So I figured it's appropriate to start off this this presentation with this quote: "Show me the incentives and I'll show you the outcome." This is from Charlie Munger, and he's not necessarily a technical wizard, but more of a financial one. He's Warren Buffett's right-hand man, because what's happening right now is as much about finance as it is engineering. And so today we're really going to talk about incentives and possible outcomes, and how those can affect the underlying networks, especially with things you guys are designing. So right now, the world as it stands today is we're kind of in the midst of this migration, where this all started, you know, a bunch of years back was this proof of work, Bitcoin and proof of work. But what we're migrating to right now steadily is kind of this proof of stake world. And we're migrating there for a number of reasons, but we're not going to get into that, but it's like most of these new networks are launching with proof of stake at their core for you know, whatever reason it is. And today the proof of stake market is still many times smaller than the proof of work market. And all of this is really very early. I mean, a lot of this stuff still feels like alpha or beta software. I mean, Ethereum's in the midst of its migration, and there are a ton of risks that are present in this process. But it's interesting to note that these migrations are happening for a reason. And it's because the first generation designers and network makers it's not their job to consider all the higher order effects. You know, the first generation protocol makers, it's their job to get things working, to get the basics tenable for proving things out. And, you know, it's not their job to consider everything down the line. So like, for example, in proof of work, it's like the first generation doesn't really consider the tendency towards centralization in mining pools. And if we're talking about proof of stake too, you see it kind of the same thing. It's like the original design mechanisms actually have tendencies towards centralization in practice. And we're seeing a little bit of that today. So, you know, you have Binance or other, you know, you have these large entities who can offer basically staking rewards with lower fees than anybody else, because what happens is they can do more with that capital when it's actually locked up in their service. And so you actually have these incentives towards centralization, which were not really understood when designing just the pure protocol. And so what does that mean? What that means is that we have the emergence of these second order effects, or these higher order effects. And something that you've probably heard a little bit about is DeFi. DeFi has been making a splash in the space, which is decentralized finance. And DeFi is a higher order effect, and it's now here and very present. But what DeFi is it's basically leveraging decentralized networks to transform kind of the old financial products that we've known into these trustless and transparent ones that are running without intermediaries. So you're probably a little bit familiar with some of them, like Compound and Maker. You know, but you know, 7-8 years ago, nobody, or maybe at least just nobody had predicted these things coming down the line. At least a lot of people were not talking about things like this. But what happened was it required the foundation to be laid by all these layer 1 protocols to establish a lot of the behaviors so that we could then create some of these higher order effects. So we're going to go a little bit deeper into this. So on the left here, imagine that this is now proof of stake. Here is our primary one. That arrow coming in from the left is from proof of work. And we're now going to talk a little bit about this DeFi migration, because right now we're in the midst of this other migration. And it's this migration of assets that had been stationary in proof of stake, now migrating over into DeFi contracts, products, and protocols. It's basically putting these assets to work in new markets and things like that. But again, kind of like when we had proof of work flowing into proof of stake, we see that DeFi is many times smaller than proof of stake on the whole. But people want to make money on their money, so the incoming flow to DeFi is really what's starting to occur, and it's going to keep growing. And why is it going to keep growing? Well, it's going to keep growing because DeFi just makes sense. A lot of crypto and a lot of these networks are relatively complicated to understand. DeFi is not. It's finance, and money is just a meme that people understand. It's like a near universal language for most of humanity, and it's using one of the oldest incentive mechanisms that people invented, which is this notion of making money on money. And so it kind of just cuts right through all the noise of technical complexity. And when people see, oh, I can make money with this, and it's just markets, and I know markets, it's a meme that connects with something that we already understand, which is something we've really not encountered yet in this space. And so the growth over the last year can kind of be attributed to this in large part. But there's an interesting question here. You've got this small DeFi market which is starting to grow. But the design surface dramatically changes the considerations for proof of stake network makers, because really what DeFi is doing is it's surfacing new incentives that the first generation protocol developers had never considered. So is it the case of like the tail wagging the dog effectively is kind of what I'm asking you guys. So because it's surfacing these things that hadn't been considered, it's smaller, but more people actually understand it. So more people are gravitating to design around it just because of that natural acceptance. So let's take a little bit of a closer look to understand. We can understand DeFi's implications on proof of stake and staking derivatives. So let's take a quick look at what DeFi actually is. So what is it about? On its surface, DeFi is about markets, right? It's about permissionless markets everywhere. The attributes, it's borderless markets everywhere. And basically, these are markets with anything you can imagine. And because it was anything you can imagine, these used to take millions of dollars or years or licenses to create, and very few could create them. But suddenly we have these protocols that allow you to do this anywhere and for anything. So for example, like Uniswap, and it's working with automated market makers. Basically now it only takes one party to show up and create an infinitely deep two-sided marketplace. But you also get this, permissionless trading right out of the box. And now you also are starting to get permissionless leverage. So you've got FutureSwap, DYDX, things like this, where you're starting to be able to take these levered positions and get outsized returns that you weren't able to do on the spot markets. And this is just starting to happen. So this notion of DeFi and permissionless markets is something that's particularly interesting, or it's a central attribute of it. What's something else? Something else is DeFi is about composability. So, one of the memes that's popular in DeFi is this notion of like money Legos, and being able to just plug A into B into C and have them all just work well together. So it's like we're seeing demanded from people who want to participate in this decentralized financial movement is a demand for composition and flexibility of any asset, so that it's basically never at rest, not earning some type of money. And so because of this type of demand for composition or flexibility, you get things that naturally must work together. So you have Ethereum that plugs into Maker, which plugs into Compound. And so what you get with these is you expect these assets to pool together. And so, we have a bunch of tools that are just starting to emerge to allow this to happen with, single click. So you have tools like InstantApp or DeFiZapp, where you basically just say, I want to pipe this asset into this one. I want it to earn this much. And basically with a single click, you can kind of compose a bunch of different protocols to earn yourself something. Again, composability is core to what we're talking about here. So what else is it about? DeFi is about yield. And I want to specifically call this out. So what is yield? We're probably hearing a lot more about it in DeFi than we have in any other kind of like ecosystem in crypto. But yield is basically the return just generated on something that you're holding over a period of time, which is why those little circles are growing, right? It's the growth of your assets over some period of time. And you're going to hear a lot about yield, because this is a place in the ecosystem that cares a lot about the rates of return and things like that. Even more so than you'll hear in a lot of other in a lot of places, because really at its core, DeFi is a new breed of financialization. And because what we're doing is we're creating new types of transparent, permissionless financial instruments and markets and protocols. And this is all actually an amazing thing that's kind of taking place, and we're all privy to it, and we're part of it. And especially it's amazing because of the properties that we're getting, such as transparency, things like that. And it's orders of magnitude better in many ways than the existing system. That's kind of what catalyzed this to begin with. It's kind of where the desire came from. But one of the things, just kind of as we're doing this, to be aware of is there are some major risks associated with financialization for the sake of financialization, especially when we think that we're protected, like when we just think that we're protected by the mere presence of these properties. And what I mean by saying that is that just because there's transparency of information, or there's transparency of, let's just say transparency, we'll use that as the example. Just because it's there, we can have this tendency to think that we're protected because it's just there. But that's really not the case, because financialization, it does introduce completely new types of asymmetries. And it really starts to blend risks and incentives in entirely new ways. Because like at the core, at like the foundation level, what we're really doing is we're throwing like blockchain and typically like historical systems engineers, and we're throwing them into the deep end with seasoned financial engineers and financial and market makers. And so there's this kind of difference in understanding of things, and a lot of these people have decades of understanding and creating markets and extracting values by way of uncovering and acting on these kind of hidden asymmetries. This is the same type of trader that will, like, you build your building across the street from an exchange, so light has the shortest trip, so you can have an information advantage. And if you can start considering the market like this, then DeFi is full of holes from this perspective. And so when we're talking about DeFi and proof of stake and staking derivatives as one of the drivers here, this can really start to undermine network security. And it might not be immediately something that just comes to mind immediately, but let's take kind of a look at how. And so in order to take a look at this, we're going to talk about incentives and behaviors. We're going to talk about a concept that's pretty well known in traditional finance. It's called delivery. But let's just say we're trading a commodity. We're trading something. You and I are trading corn. There's physical delivery and there's paper delivery. So in the world of physical delivery, if you and I are trading corn, basically we're going to care about delivery means that I'm going to deliver you the corn at the end of the day. So physical delivery actually leads to the physical corn being delivered. And so in this case, when we're talking about incentives and behaviors, people care about different things. And if we're talking physical delivery at the end of the day, then you and I are actually going to care about the health of the corn. And that's something, so basically the nature of delivery, physical in this case, helps line up our incentives that both you and I want the underlying health of the corn to be something that is of high priority. But there's another type of delivery that's common, and it's called paper delivery. So paper delivery, on the other hand, is basically, it's where if you and I are trading, say, corn, we're not trading the underlying corn and delivering it physically, but what we're doing is we're just trading on top of the corn, positions on top of the corn. So if the price of corn moves in a particular way, up or down, we can make money on the position, but we never actually necessarily have to deliver the corn. And so what we're doing is just delivering paper. The corn can be, in this dumpster on fire, and the health of the underlying asset can actually be garbage. But if you or I made money on the trade, then we're pretty happy. And so the difference between paper delivery and physical delivery is this concept of people actually caring about the health of the underlying asset, and the fact that you can make money in a number of ways. So what does DeFi, though, have to do with delivery? Delivery have to do with DeFi? Well, let's kind of take a look at what this actually means. So in this kind of first version of staking, it's like generation 1 of staking is a lot like the physical delivery world, where there's a lot of talk of staking derivatives, and people want to put their money to work right now because of DeFi. But it's a slightly different world than what we've been used to, because in this world where we've been and where we largely are right now, the primary yield on whatever your asset is comes from kind of this mix of things. It's all kind of like blended together. You get, speculation and token appreciation, but also network adoption and network security are all kind of like linked together in this like simple one-hop layer 1 staking thing. They're all kind of like there together, and essentially yield from staking. So if I stake my tokens over in the service, the yield from that staking is kind of a secondary mechanic to secure the network and encourage participation. But it's kind of like physical delivery in that the health of the underlying network is closely linked to everything else, and so I'm incentivized to to propagate the network, do things that are healthy for it. But when you start to introduce deliveries or paper delivery, or derivatives, it kind of starts to get closer to the world of paper delivery, where you had this layer 1 and staking relationship, but now you have this kind of this introduction of a derivatives layer, and this kind of what I'm saying is this creates possibly an abstraction where people in this market don't necessarily need to care about the health of the underlying network as long as they can make a profit on the position, right? Like this second hop is a derivation that starts to segment these things out, where now effectively you have derivatives that are seeking yield purely for yield's sake, which is quite a departure, because in this first version you had yield, which was also tied into network security, network adoption. But once you have this layer of hop in here, you basically have a layer of abstraction where you just can seek yield. And so then the corn or the network itself can be on fire, but you or I can still make a handsome profit on whatever the position was that we opened. And so what does this mean? Why is this interesting for proof of stake especially? Because we're going to introduce you to this concept of the risk-free rate. Like in finance, there's this concept of the risk-free rate, which is basically the rate you're going to be paid for taking on some risk above something that's considered risk-free. So like 3-month T-bills are considered risk-free because it's like the government won't default on some bond in that period of time. So anything above that is actually risk-seeking behavior. And so seeking yield above the risk-free rate literally is this risk-seeking behavior. And so seeking yield in most cases is seeking risk that others won't necessarily bear. And so, one of the questions that I want to raise is, how does this necessarily affect the health of the underlying networks? So in kind of this first generation world, you have adoption and security and yield all kind of wound up together. And that's, let's use this like little blue ball, or as this blue circle as like, today's market. But we're going to make a couple of assumptions here in this next statement. The assumptions are that, let's imagine that DeFi trends continue and liquidity continues to grow, and spontaneous markets everywhere continues to grow, and permissionless leverage is something that continues to be demanded. So you have this growth. So DeFi starts to be able to create large liquid levered markets for almost anything you can imagine. And this starts to completely change the nature of network risk and security, because you start to have this market size in this market that eclipses the traditional one where it's solely about the seeking of yield. And I'm not saying we shouldn't do this. I'm just saying we should be aware of this. And so what this does, though, is this starts to completely change the nature of network risk and security, especially when the market size on this right and the potential return over here eclipses that on the left, even for a moment, for one party. I mean, it really only takes one position or one short to make this thing worthwhile for someone. And so remember, as we were talking about asymmetries and understanding, and people who've been doing this for a long time relative to those who haven't, only a few people need to see these things to be able to act on them. So, like, what's going to happen to our underlying networks? Like, there's a lot of concern, or at least I have a lot of questions. And to tell you the truth, I'm not necessarily sure. Because supposedly we're doing this for good reason. There's a lot of talk about composition, and we're doing this to put our unproductive assets to work so that we get yield and things like this. And we're taking on a lot more risk. So we had better get a lot out of it. We had better get more yield. We had better get a lot of liquidity. We better get compensated for a lot of this risk that we're actually taking on. And on the surface, it looks like everything's okay. Like, we're actually going to get these things, but in practice, it might not be. Like, what if all the benefits that we think we're going to get what if they're an illusion? At least as it stands right now. Like, we need to design things around there, because what I'm going to show you is we've got a lot of these counterintuitive issues that start to crop up that we have really yet to solve. You don't necessarily see them talked about in a lot of places. And so let's look at a couple of these. In theory, derivatives are fungible, right? Like, if you run a staking service and I run a staking service on some network, and we've got a bunch of delegates stake with us, and then we issue derivatives on top of that, like, those derivatives all pool into the same pool. They're all the same thing, right? But in practice, these things are not necessarily fungible, because the inherent risk inside of in an issued derivative from a particular staking service is not. So let's just look at a quick example. In this scenario, let's just say, like, the question is, which derivative is actually riskier? So let's say that the service on the left was slashed before because of they were running a redundant node. They were having network issues, and so they spun up a redundant node, which means they double signed a transaction, and boom, they got slashed. And so it wasn't because they were a malicious actor. It was because of just their network architecture why they got slashed. So maybe they learned from that, maybe they didn't. But network A, or validator A, has been slashed before. Now, validator B, on the other hand, has low latency, great operating history, has never been slashed. So the question is, are derivatives coming out of both of these services the same thing? So in this way, like, the point is that from both services, these things are non-fungible because they necessarily have different risks. At least if we can ignore that and just pretend like they're the same thing, but in practice they're not. And pretending like risk just doesn't exist really usually doesn't end well in the markets. So now, what else? So in theory, we're doing all of this to get more liquidity to work with. Like, I put my assets in a staking service and I get out this derivative, and then we've got more instant liquidity. So all the hundreds of millions that were going to just go to staking and just be stagnant, it was effectively put back on the market to do something with. But in practice, we have these aggregation issues because what we just saw is that they're non-fungible, and so the risk is different. And so unless we just ignore these differences, which is I don't espouse this option, but it's a total option. You can ignore the differences because humans have done this before. It's not a particularly good outcome. But if you don't ignore them and you realize that we need to price this risk effectively, then you get these liquidity aggregation issues. And so, one of the notes here, just a side note, is that we need businesses and protocols that are going to be built just to effectively price the risk coming off of these derivatives. We don't have really any of that yet, even though there's a lot of talk about derivative and staking services. Okay, so what else? We get some weird things happening. So, in theory, we have markets as usual. So let's say that all these things are fungible and that we have new markets created on top of this. But some of the questions I have arise from just the staking idiosyncrasies of, the practice itself. So like, what happens to the markets on top of these staked derivatives under certain conditions? So there's a lot more thought that can be put into this, but it's, one corner case is like what happens to some leveraged derivative market if a staker is suddenly slashed? What happens to all those positions? So basically, there's a lot more complexity to cover than is kind of showing up just immediately here. And then, as a kicker, because I'm at IDEO and I think a lot about user experience and the design of products as well. As an added bonus to all this, we get a ton of user experience issues. So like, was on a panel last night with some folks, and like there are a lot of good steps being taken to improve the experience here, but this is still really early. And people engaging with networks, it's still a challenging experience occasionally. But we get these weird things like it's not exactly intuitive that if I stake my tokens with a different validator, that I'm getting out different instruments. And so we're just going to be adding this kind of complexity in a space where the UX is already really, really rough. Because some of the questions I have around this are like, what do wallets actually show? What do you have when you get a staked derivative? I'll give a quick example of this of like, because there's this expectation of fungibility, but it's like really there's kind of a burden on clients now to describe or show what people hold. We need new design language, and I'll show like, so let's take Compound for example. I'm not knocking on Compound; they have a great design, but I'm just using this as to describe the scenario. Like the notion of C tokens, and right, you can see the C wrapping whatever this asset is. Well, as you start to get these derivatives from different services, what is like? Do you just wrap it with an E, or with like what happens basically to the clients that are starting to show the assets that people own? How does it work? So one thing that we might start needing to do is creating a design language for whatever shows that something is actually a staked derivative. But basically, this is just kind of one subset of user experience issues and problems that start to crop up as a result of just moving into the derivative space. So we need a design language also to start accompanying this landscape, at least at the client level. So anyways, what is the big issue? The big issue here that I'm trying to call out is that we have this kind of hidden and unpriced risk for these like derivative assets and these underlying risks. And we think we understand these things, but as we've seen, this like lack of understanding can actually lead to a detrimental effect on the health of these underlying networks, because what we're really doing is we're changing the incentive alignments, and we're not yet considering how to effectively price the risk. But the much bigger issue here is this. It's that we think today is different, but we think today is really different. We've got with blockchains and DeFi, because we have the data, and not just we do, but literally like everybody has the data. And so it becomes really easy to fool ourselves into thinking that because we have the data, we're going to use it intelligently and we're going to repeat history, or we're not going to repeat history. Because in the 2008, let's take it as the financial crisis there. It's like we didn't have the data. The financial markets are so opaque. And so if we just understood and saw things, we wouldn't create the same things. Because I mean, this is what created the whole issue with CDOs in the first place. If you haven't read or go see The Big Short, it'll kind of describe these things. But it's like, now we have the data, so we're not going to do it again. But there's, my point is that pretending technical composability, automatically warrants financial fungibility is just false. Because humans love to recreate history. And the way we're heading, it's like we're going to be constructing similar scenarios if we're not careful, except this time we're actually going to know what the composition of the asset bundles are, but we'll still remain ignorant of pricing the actual risks. And so like I am 110% for this experiment unfolding. Like I work at the house of prototyping at IDEO CoLab. We do a ton of this stuff. So all this stuff needs to continue. But it's like as you're building new services, my only nudge is to ask you to understand history and really understand how to use the information that's available to see and categorize these risks, to share those risks with other people in the network so that you can reduce the overall systemic risk, and mostly to use this new information to create new ways of aligning incentives for not just the health of this new topology, but the underlying networks as well. And I know that's the case, but just resurfacing it. So I am saying build and prototype and continue to do this thing, but I'm saying build with awareness. Anyways, yeah, risk pricing is hard. That's it on my end. Just kind of getting into some of the comments here. Yeah, pricing risk is an extremely hard problem. I mean, that's kind of the nature of the game. I mean, the whole thing is about risk and risk pricing. Risk is non-stationary. Good luck tokenizing. Yes. Anyways, if there's any questions or anything like that, feel free to pop them into the channel. There's been a handful of comments here, so it's kind of like me scrolling backwards. So feel free to add things at the bottom here if you want me to take them. Otherwise, we'll wrap it up. And all right. Let me figure out how to hand this thing off. Okay, I'll answer a couple questions as I'm getting Shinju and things in here. Are there certain tests or methodologies for assessing these types? Or are there? Shinju? So are there certain types of methodologies for assessing this risk? I know we can't get rid of all the risk, but is there any? There are. You know, I was just talking with a guy named Marwan. I think he's actually on after me, talking about how to price this risk and different ways of managing this with a protocol in particular. And yeah, Noah, to your point, DeFi is about creating transparency in traditional finance. It totally is. That's the point. That's why it's, you know, like I said, orders of magnitude better than what we've got right now. I'm just saying, as we kind of step into this new world where it's built on top of these other networks with different properties, we take those into consideration so that we do it better this time around as we're creating these other layers of derivatives. And in terms of how our company is designing derivatives, so our team, we're not necessarily designing them, but we're working with, you know, starting to work with some teams on designing different protocols and projects. So we don't necessarily, but I am quite keen to figure out what is the design language at the client level and actually at the protocol level. Like, you've got design throughout the stack, and so we've got some challenges there. One sec. Yeah, quick bit of, somebody's asking about a little bit of background on team. So yeah, I work with IDEO Collab Ventures. So our team has been in the crypto space and design space for a long time. I was the founding engineer at BitGo a long time ago. I've been working on different things, worked on a lot of open source protocols and projects, work with Dan Elitzer, Tara Tan, Joe Gerber, and Ian Lee. It's kind of a spread of things from people who have started the MIT Bitcoin Club, people who have designed a whole bunch of things and worked on, a bunch of OG projects and products. So anyways, we're a collective of people who work with, and at IDEO, so bringing kind of this, one of the world's deepest design capabilities into this space. So that's kind of one of the lenses of our team, but we span kind of this ability to design protocols because we have deep fluency in engineering, but also design. So we kind of work across that area. And in terms of design language that I'm talking about, yeah, I was mentioning on that last slide about the UX issues. You know, some of the things about staking idiosyncrasies or, you know, liquidity aggregation and non-fungibility. those are not necessarily UX. Those are protocol based. But the thing that I tapped on at the end of the kind of presentation on UX issues, with regards to visual representations and things like that, those are a little bit higher in the stack in NetProducts. So yeah, you've got things from the protocol level all the way up to the product interface. But either way, we've kind of got this slew of things to start tackling together. So if you're starting to build a service or design a product, also start considering which one of these types of areas that you want to start taking on and sharing with the community about possible solutions.
Yes, I can. Can you hear me?
All right, so thank you so much for the really great session. So what we're going to do is take a short break, and we will restart at 10 a.m. And we will have the CEO of Unsplash talking about building on DeFi, staking derivatives, opportunity squared. And
Perfect.
yes, and Gavin, sincerely, this was amazing. I actually learned a lot. Yes. All right. Well, thank you again. And Gavin will be sharing the slides afterwards, and we'll post it online.
Yeah, thanks for the comments, everyone, and thanks, Shinju.
All right, take care.